Welcome to today's Explainer. We're jumping right into one of the most fascinating infrastructure stories hitting the market right now. We're breaking down ERock, which recently listed under the ticker EROC in a massive $600 million IPO. But this isn't just your standard public offering story. We're going to explore a brilliant strategic pivot. We'll look at how this company completely transformed itself from a traditional backup power provider into a microgrid powerhouse, squarely targeting the explosive, energy-hungry AI boom. Okay, here's our roadmap for today. We'll cover AI's massive power problem, the pivot to microgrids, a billion-dollar backlog, valuing electricity scarcity, and finally, the path to profitability. Let's dive in. Section 1. AI's massive power problem. The grid's tipping point. 224 gigawatts. That is just a staggering figure. It represents the projected summer peak demand growth on the U.S. grid over the next decade. That's roughly the power needed to run millions of homes, and it's being demanded almost entirely by tech giants, AI infrastructure, and hyperscale data centers. And honestly, the traditional power grid, with its aging transmission lines and those notoriously years-long interconnection queues, simply cannot keep up with the speed at which these facilities need to be built. The immediate strain is intense. In 2024 alone, global data center electricity consumption reached roughly 415 terawatt-hours. To put that into perspective, that's about 1.5% of total global electricity use, and it is growing at double-digit rates every single year. These data centers are literally starving for firm, dispatchable power. Because if you can't get power, well, you can't build the data center. It really is that simple. Moving to Section 2, the pivot to microgrids. Let's look at ERock's 2019 strategic shift. So the absolutely crucial piece of this story is their 2019 pivot. Previously, ERock, which was known as Enchanted Rock back then, focused on traditional diesel backup generators. You know the type. They basically just sit idle in a basement until the power goes out. But management recognized a massive shifting tide. They transitioned to a low-emission, natural gas-fueled resiliency-as-a-service model. Essentially, they moved from selling idle emergency equipment to providing fully integrated utility-grade microgrids that can run continuously, bridge the gap while waiting for those slow utility connections, and even sell power back to the grid during peak demand. It was a total masterstroke in business strategy. The specific technology making this pivot possible is called the Rock Block. It's a highly modular system, meaning if you need more power, you just add another block. But the real magic here is what ERock calls speed to power. Right now, a data center might wait literal years for a permanent utility connection. ERock can deploy these rock block systems and get a customer running in as little as 6 months. They're essentially selling time, which, when you look at the current AI arms race, is the most valuable commodity of all. And to prove this isn't just some concept sketched out on a whiteboard, look at their existing real-world footprint. They already have over a gigawatt of installed capacity across 400 sites. Plus, their Granite software ensures 99.999% reliability, and they've actively supported the grid during hundreds of thousands of peak events. But maybe most importantly, the enterprise clients relying on these rapid power deployments include absolute heavyweights like Microsoft, Walmart, and Foxconn. This installed base proves their microgrid pivot works at the very highest levels of the industry. Let's jump into Section 3, a billion-dollar backlog, the financial proof of the pivot. The financial success of this strategic shift is just staggering. The leap in demand is extraordinary. Back in March 2025, their contracted backlog was a very respectable $145.2 million. Fast forward exactly 1 year to March 2026, and that backlog exploded to $1.28 billion. That is a massive 778.6% surge in just 12 months. This right here is the direct financial evidence that the market is aggressively buying what ERock is selling to solve the AI power shortage. But look, having a billion-dollar backlog is one thing, actually executing on it is a whole different ballgame. To pull it off, ERock totally retooled its leadership. In late 2025, they brought in CEO John Carrington, a veteran who previously took the clean energy firm STEM public, alongside COO Paul Fruton, who literally used to run Google's global data centers. And pay attention to how they're compensated. They are highly incentivized by Class M equity units. They don't win unless the shareholders win, meaning this executive team was purpose-built and incredibly motivated to turn that massive backlog into installed, revenue-generating systems. Section 4. Valuing electricity scarcity. The financial reality of the ERock IPO. There's a really fascinating tug-of-war happening with ERock's valuation right now. On a price-to-sales basis at 5.4 times, ERock looks pretty expensive. It's well above the U.S. electrical average. That suggests investors are paying a hefty premium for future growth. Yet, if you run a discounted cash flow model based on that massive backlog we just talked about, the stock actually screens as highly undervalued. So, the market is currently debating, are you buying an overvalued hardware company or an undervalued AI infrastructure play? And while the backlog and revenue growth are unquestionably impressive, revenue jumped to $183.1 million in 2025, we can't ignore the bottom line reality. The company still reported a $59 million net loss in 2025 and continued to post losses into early 2026. This is the real crux of the issue. Scaling to hardware-heavy, vertically integrated energy business is incredibly capital-intensive. They're selling the systems, for sure, but they haven't yet proven they can manufacture and install them profitably at this new hyperscale level. Plus, it's really important to understand the mechanics of the IPO itself. They raised roughly $600 million, but that cash doesn't just go straight into building new factories. A lot of it facilitates an Up-C structural reorganization. Basically, that's a complex way to provide early backers with cash payouts and pre-IPO liquidity, while allowing them to maintain voting control. So as a new public investor, you're buying into a structure where the original insiders still maintain a very firm 78% grip on the company's direction. Finally, Section 5, the path to profitability. Let's look at the scaling risks and future hurdles. To actually meet those massive backlog commitments, ERock has to execute, and fast. They need to standardize their designs to move away from bespoke custom projects, and they have to massively expand their manufacturing footprint in Houston, moving from their current Titan facility to a new, much larger Hyperion facility. Their stated goal is to reach 1.2 gigawatts of annual assembly capacity by the end of 2026. If they stumble here during the manufacturing scale-up, that crucial speed-to-power advantage completely disappears. We also have to stay completely objective about the external risks. ERock's microgrids rely on natural gas. Yes, it's cleaner than diesel, but it still emits carbon. And hyperscale data centers have incredibly strict zero-carbon emissions targets right now. Furthermore, deploying natural gas pipelines and generators invites serious permitting scrutiny and potential local opposition. If a local government delays a permit, ERock's primary selling point, speed, evaporates. They really have to thread a tight needle between fast deployment, environmental compliance, and improving their gross margins. So, I want to leave you with this provocative thought to ponder as we watch this story unfold. We absolutely know AI needs power, and we know ERock can deliver it fast thanks to their brilliant microgrid pivot. But can a gas-powered solution to today's electricity shortage avoid becoming tomorrow's emissions constraint? Can ERock's fast power truly become profitable, sustainable power in the long run? It is going to be a fascinating journey to watch. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you next time.